Debt used to destroy people who couldn't pay it back. Now it enriches people who never lend a penny. That sounds backwards because we're taught that debt is borrowing money from lenders who want repayment with interest. But look at how modern debt actually works. And you're looking at a system where banks profit more from debt creation than debt collection, where defaults generate income through insurance and tax benefits, and where the people who bear borrowing risk have no control over lending decisions. The system stopped optimizing for debt repayment decades ago. It now optimizes for debt proliferation. The borrower's obligation became the investor's opportunity. Welcome to the Financial Historian, where money, power, and history collide, and nothing is ever as simple as it looks. When people think about debt, they imagine personal obligation, moral responsibility, and the expectation of repayment. The language supports this narrative. People owe money, face consequences for default, and have obligations to creditors. This framing makes debt seem like a direct relationship between borrower and lender, where both parties share interest in successful repayment. But that framing conceals debt's actual function in modern finance, converting human promises into tradable assets that generate returns regardless of whether the original promises are kept. To understand how revolutionary this transformation was, consider how debt operated before it became financialized. Throughout most of human history, lending was personal, local, and risky for both parties. When someone borrowed money, they entered into a direct relationship with a specific lender who faced real loss if the borrower couldn't repay. The lender had to evaluate character, capacity, and collateral because they would bear the full consequences of a bad judgment. Borrowers faced social ostracism, legal prosecution, and sometimes physical confinement if they defaulted on obligations. This personal accountability system had natural constraints that limited both debt creation and debt abuse. Lenders couldn't make loans they couldn't afford to lose because they retained all the risk. Borrowers couldn't take on obligations they couldn't handle because the consequences were immediate and severe. Communities had strong incentives to help people avoid excessive debt because defaults affected everyone in the local network. The system was inherently conservative because both sides faced direct consequences for poor decisions. Debtor's prison epitomized this personal accountability approach. People who couldn't pay their debts were physically confined until they found ways to satisfy their obligations. This wasn't just punishment, it was a credit enforcement mechanism that made lending viable in societies without sophisticated legal systems. Lenders knew they could recover their principal through debtor confinement, while potential borrowers knew that default carried consequences severe enough to prevent casual borrowing. The system worked when lending was limited to people with established reputations and when debt was used primarily for productive purposes that generated income to service obligations. It broke down as commerce expanded beyond local communities and as debt began serving consumption rather than investment. Anonymous borrowers could disappear. Productive investments could fail. Economic cycles could make reasonable debts unpayable through circumstances beyond borrower control. The personal accountability model became inadequate for commercial expansion. Early financial innovation addressed these problems by creating institutions that could evaluate credit risk more systematically and absorb losses more effectively than individual lenders. Banks emerged as intermediaries between savers and borrowers, using professional expertise and diversified portfolios to manage credit risk that individual lenders couldn't handle. This appeared to maintain the basic structure. Borrowers owed money to institutions that wanted repayment, while making the system more efficient and reliable. But the institutional model contained the seeds of a fundamental transformation that wasn't immediately visible. Banks didn't just intermediate between savers and borrowers, they began creating money through the lending process itself. When banks made loans, they didn't transfer existing deposits to borrowers. They created new deposit accounts credited to borrowers while maintaining claims on borrowers for repayment. The lending process expanded the money supply rather than redistributing existing money. This money creation function gave banks different incentives than traditional lenders had. Individual lenders wanted borrowers to repay principal because they had to recover their original capital. Banks wanted borrowers to service debt because they profited from ongoing interest payments, but they didn't need to recover pre-existing capital because the capital was created through the lending process. Debt service became more valuable than debt repayment because it generated continuous income streams rather than one-time capital recovery. The incentive shift was subtle but crucial. Instead of optimizing for borrower success in repaying principal, the system began optimizing for borrower capacity to service interest. Instead of conservative underwriting that minimized default risk, lending standards evolved to maximize the population that could qualify for debt service. Instead of debt as temporary assistance for productive investment, debt became permanent income extraction from ongoing economic activity. This transformation accelerated when banks learned to sell loans rather than hold them. Instead of maintaining long-term relationships with borrowers and bearing default risk over loan lifespans, banks could originate loans and transfer them to other institutions immediately after closing. The originating bank captured fees for loan production while transferring performance risk to secondary market investors who never met the borrowers and had no involvement in underwriting decisions. Loan securitization completed this risk transfer process by packaging individual loans into tradable securities that could be sold to institutional investors seeking yield. Mortgages became mortgage-backed securities. Credit card debt became asset-backed securities. Student loans became education debt instruments. Auto loans became vehicle-backed bonds. Every category of personal debt was transformed into investment assets that generated returns for people who never extended credit to the original borrowers. This securitization process broke the traditional alignment between lender and borrower interests. Original lenders profited from loan origination volume rather than loan performance. Secondary market investors profited from debt service payments but had no control over borrower selection or loan terms. Rating agencies profited from securitization transaction volume rather than accurate risk assessment. The chain of intermediation meant that everyone in the system could profit while borrowers bore all the performance risk. The mathematical beauty of securitization was that it made individual borrower default irrelevant to system profitability. If loans were properly diversified across geographic regions, income levels, and economic sectors, predictable default rates became manageable business expenses rather than catastrophic losses. The system could profit from aggregate performance of borrower pools, even when significant percentages of individual borrowers defaulted. This portfolio approach fundamentally changed debt from personal obligation to statistical phenomenon. Instead of viewing default as borrower failure that should be prevented, the system began treating default as predictable cost that should be priced. Instead of bankruptcy as system failure, it became portfolio management tool that cleared unproductive accounts. Modern credit scoring systems reflect this statistical approach to human obligation. Instead of evaluating borrowers as individuals with unique circumstances and moral commitments, algorithms assess them as data points in risk categories that predict payment probability distributions. The scoring process optimizes for system profitability rather than borrower welfare, identifying people likely to generate fee income through debt service, while avoiding those likely to default quickly or repay principal early. Credit card companies illustrate how completely the incentive structure inverted. The most profitable customers aren't those who pay their balances in full each month. They generate no interest income. The most profitable customers are those who maintain steady balances while making minimum payments reliably over extended periods. The optimal customer from a profitability perspective is someone who never pays off their debt but never defaults either. The system profits from permanent debt service rather than temporary credit assistance. This explains why credit marketing focuses on spending encouragement rather than repayment planning. Credit limits increase automatically to encourage higher balances. Minimum payments are calculated to extend repayment periods rather than minimize interest costs. Balance transfer offers shuffled debt between accounts rather than reducing total obligations. Cash advance features encourage debt accumulation for consumption rather than productive investment. Every system feature optimizes for debt expansion rather than debt resolution. Mortgage lending follows the same logic despite appearing more conservative. Banks profit from loan origination fees, servicing income, and secondary market sales rather than successful home ownership outcomes. The optimal mortgage from a bank perspective generates steady payments over long periods while requiring periodic refinancing that produces additional fee income. Principal reduction is less valuable than payment reliability because principal reduction reduces the asset base that generates returns. This is why mortgage modifications during economic crises typically extend payment periods and reduce monthly payments rather than reducing principal balances. The modifications preserve bank income streams while providing borrower payment relief, but they increase total interest costs over loan lifespans. The system optimizes for payment sustainability rather than ownership transfer because ownership transfer eliminates the debt asset that generates ongoing returns. Student lending demonstrates the logical extreme of debt as asset thinking. Student loans are specifically designed to be non-dischargeable in bankruptcy, ensuring that borrowers remain obligated regardless of economic outcomes or educational value received. The loans are secured by future earning potential rather than current assets, creating permanent claims on borrower income streams. The system profits from educational credentialism that requires debt financing rather than educational outcomes that enable debt repayment. The mathematical elegance is perfect. Students must borrow to access employment credentials that generate income to service debt incurred to obtain the credentials. The system becomes self-reinforcing as credential requirements expand to justify debt expansion. Educational institutions raise prices to capture debt availability, while employers demand credentials to filter applicants. Students become permanent debtors, while institutions and lenders capture the value of their future labor. Corporate debt markets reveal how completely debt transformed from obligation to opportunity. Companies use debt not because they lack capital, but because debt provides tax advantages, leveraged returns, and financial flexibility that equity financing doesn't offer. Corporate bankruptcies became strategic tools for shedding obligations while preserving assets rather than last resort admissions of failure. Debt restructuring became routine corporate finance rather than crisis management. Private equity firms perfected debt weaponization by using leveraged buyouts to load acquired companies with debt service obligations that extracted cash flow while transferring ownership risk to debt holders. The acquired companies bore debt service burdens while private equity captured upside through operational improvements and eventual sales. When debt service proved unsustainable, bankruptcy eliminated obligations while preserving valuable assets for new ownership structures. This strategic approach to debt and default illustrates how completely the moral framework disappeared from lending relationships. Corporate borrowers optimize debt usage for tax benefits rather than operational necessity. Lenders evaluate credit risk through portfolio management rather than relationship assessment. The entire system operates according to mathematical optimization rather than ethical principles. The transformation was completed when governments made debt accumulation necessary for basic economic participation. Mortgage debt became required for home ownership. Student debt became required for employment credentials. Consumer debt became required for credit score maintenance that enabled access to additional debt. Auto debt became required for employment access in car-dependent communities. The system eliminated debt-free alternatives to major life activities, making borrowing involuntary rather than optional. This mandatory debt participation creates captive markets where borrowers can't exit the system without exiting economic opportunity. Credit scoring systems punish people who avoid debt by classifying them as credit risks due to insufficient borrowing history. The absence of debt becomes evidence of potential default risk rather than evidence of financial prudence. The system requires debt participation to demonstrate creditworthiness for additional debt access. Modern bankruptcy illustrates the complete inversion of debt's moral framework. Personal bankruptcy changed from shameful failure requiring lifetime consequences to routine financial management requiring temporary inconvenience. Bankruptcy attorneys advertise debt discharge as consumer right rather than desperate last resort. Credit counseling focuses on post-bankruptcy rebuilding rather than pre-bankruptcy prevention. The system treats bankruptcy as debt portfolio management rather than moral reckoning. The speed of post-bankruptcy credit restoration reveals the system's actual priorities. Borrowers can qualify for new credit within months of bankruptcy discharge because their debt-to-income ratios improve when previous obligations are eliminated. The bankruptcy eliminates competing claims on borrower income, making them attractive customers for new debt creation. The system profits from borrower financial failure because failure clears the balance sheet for additional lending opportunities. Understanding debt's transformation from personal obligation to investment asset explains many features of modern economic life that seem puzzling under traditional narratives. People aren't irresponsible when they struggle with debt burdens. They're responding to systems designed to maximize debt accumulation rather than successful repayment. Companies aren't being predatory when they profit from borrower distress. They're optimizing returns within legal frameworks that reward debt expansion over debt resolution. The problem isn't individual behavior or corporate greed. The problem is systematic design that transformed debt from tool-serving borrower needs into asset-serving investor returns. The transformation wasn't accidental or inevitable. It was the result of specific policy choices about financial regulation, bankruptcy law, and institutional design that prioritized system efficiency over individual welfare. The lesson isn't that debt is evil or that lending should be eliminated. The lesson is that debt relationships reflect power structures rather than natural market forces. and that those structures could be designed differently if societies prioritized different outcomes. Current arrangements persist because they serve powerful interests while maintaining political legitimacy through complexity that obscures wealth transfer mechanisms. The mortgage crisis of 2008 revealed these dynamics when securitization chains broke down and required government intervention. But the intervention restored system function rather than reforming system design. The same institutions that created unsustainable debt burdens were recapitalized to resume debt creation using modified procedures that preserved fundamental incentive structures. Debt didn't transform from shame to profit through natural evolution or technological progress. It transformed through deliberate policy choices that prioritized financial system expansion over borrower protection. Those choices could be reversed if societies decided that debt should serve borrower needs rather than investor returns. But reversal would require acknowledging that current arrangements represent specific political decisions rather than inevitable economic developments. Modern debt markets followed the English institutional model to its logical conclusion. Complete separation of debt creation from debt consequence, conversion of personal obligation into tradable asset, and optimization of system function over individual outcome. The system works perfectly for maximizing debt proliferation and investment returns. It works terribly for providing credit assistance that improves borrower financial conditions. Understanding this explains why debt relationships can be structured differently, but current arrangements persist. The architecture determines the outcome, and architecture can be changed. But it rarely changes voluntarily when it's working effectively for those who control it.